Hello everyone. Here we have a very interesting question from the world of options trading strategies and profit analysis, uh, or you can say payoff analysis. Let's dive right into it. Now, this is the question: an investor sells a January 2025 call option on the stock of ABC Corp with a strike price of $70 for $13 and buys a January 2025, so same month, expiration month is same. So buys a January 2025 call option on the same stock with a strike price of $80 for $5. So you have to tell what is the name of this strategy and what are the maximum profit and maximum loss you have to find out that the investor could incur at expiration. So here are your options: a bear call spread and a bull call spread with varying maximum profits and losses, right? So consider these numbers very carefully to choose the correct answer and take a moment to note this down if required. Okay. Now, by the way, this type of question is very relevant to the FRM Part 1 as well as the CFA Level 2 exams, where option strategies as well as the payoffs, profit structure, all these things are tested in detail. So if you're preparing for either of these exams, this is a great example to understand the nuances of options trading and the payoffs and profits. All right. Okay. Let's break this down together. First, let's identify the strategy. Okay, that is the first job. What is the strategy? Now, investor is selling a call option with a lower strike price, that is $70, and investor is buying the call option with a higher strike price. Okay, so this is a classic bear call spread strategy. Okay, where the investor is selling the call option at lower strike price, buying at a higher strike price. It is designed to profit when the stock price stays below the lower strike price. Okay. Now let's calculate the net premium which is received. Let's calculate the net premium which is received over here. Now, if you see, the investor receives a premium of how much? $13 over here for the call option which the investor has sold, the $70 strike price one, and the investor pays $5 for buying the $80 call, right? So the net premium which is received, not paid. Okay, so net premium is received over here, which is equal to 13 minus 5, which is nothing but $8. Okay, so $8 is the net premium which is received. Now let's calculate the maximum profit. See, the maximum profit occurs if the stock price stays below the lower strike price. So we can say that the maximum profit will occur when the price stays below the lower strike price K1. Okay, or when S is less than basically 70. Okay, so both options expire worthless in this case. In this case, both options expire worthless and the investor keeps the net premium. So this is your max profit, which is the net premium received, which is nothing but $8. Okay, now let's figure out the maximum loss. So the maximum loss will occur when the stock price goes above the higher strike price of $80. Okay, so here's the math. Now the spread between the strike price, in fact we have derived this in the class in great detail. I'll just give you an intuitive understanding here also. The spread between the strike prices is nothing but K2 minus K1. So K2 minus K1, basically I'm trying to calculate. K2 minus K1 is 80 minus 70, which is nothing but $10, right? So this is the spread between the strike prices. Since the investor received a net premium of $8, the maximum loss, as I said, the maximum loss occurs when, remember, when S is greater than K2, okay, or when S is greater than 80. So the spread is $10 and the net premium received is $8. So the maximum loss the maximum loss is equal to $10 minus $8, which is $2 USD 2. So you can think of it like this. The difference, why did I calculate K2 minus K1? The difference in the strike prices, K2 minus K1 or $10 is the maximum exposure you can have when the stock price skyrockets. Even if it goes way beyond 80, still the maximum exposure is how much? $10 only, because the call option which you have bought is going to offset all the losses from the call option which you have sold beyond a certain point, which is $80, right? The stock price when it goes above $80. So since you have received $8 of premium upfront from selling the options or selling and buying the options basically, that is why your total loss is reduced to just $2. This is your maximum exposure of $10. Okay. And this premium received, which acts as a cushion, you can say kind of a cushion, protecting you from bearing the full impact of the difference in the strike prices. Okay. So your maximum profit we calculated, maximum loss we calculated. So what is the correct answer over here? What is the correct answer over here? The correct answer is maximum profit. It is a bear call spread, maximum profit $8, maximum loss $2. So the correct option is option B. Okay. Now that we have worked through the logic and the calculations behind this bear call spread, let's move to Excel to visualize the payoff structure also. Okay, the payoff structure will be something like this. Okay, this will be the graph of a bear call spread. So this visualization with Excel will also make the strategy to you even more clear, and it will help you see how the profits and losses behave across different strike prices. Okay, so here's the Excel. Now the left section, the particulars over here. This section provides key details for setting up the strategy. Now underlying, as we mentioned, we are talking about the stock of ABC Corp. So the underlying is ABC Corp. Then the short call strike price K1. Now here the trader has sold a call option at a strike price of how much? $70, if you remember, right? So this will be 70, and this is the lowest strike price, of course, in the strategy. Then the trader has bought a call option with a strike price of 80. So that's your K2, 80. So the long call strike price K2 will be 80 over here. Now the trader paid a premium of $5 for the long call, and the trader received a premium of $13 for the short call, right? So $13 received for the short call, $5 paid for the long call, which means that the net premium received is nothing but 13 minus 5, that is $8. Now what we'll have to do to calculate the long call payoff, then short call payoff, profits, we'll have to fix some entries using the F4 button. So to ensure that the formulas work correctly across all rows, we'll actually use absolute references, right? Or you can say fixed cell references for inputs like strike prices and premiums, because they don't change, right? So while entering these formulas, we'll press F4, and of course, those who have dealt with Excel, they already know this. Most of you know this, that we use F4 to fix the references, and fixing the values of premium and strike prices will ensure that these references remain consistent when the formulas are copied across different rows. Now the right side of Excel, which we actually calculated, the max profit, max loss, all these parameters we've already calculated earlier. We have also added a new parameter, breakeven, over here. Okay, so the intuition also behind this I've told you, explained you, but I think before jumping into these in the Excel sheet, it's better to first analyze the payoff diagram and the profit loss behavior for various stock prices. Okay, so once we have fully understood the mechanics, the formulas for these metrics will feel more intuitive, just like we did in the discussion section earlier. So we'll just hold off this column F for these particular values, right? These four parameters for now. Okay. Now let's come to the stock prices at expiration. Now this column will list the possible stock prices at expiration. So in this column, we'll input a range of possible stock prices at the time of option expiration. These prices will represent the different market scenarios that could occur and of course they'll help us analyze the strategy's performance across different outcomes. So for this example, I'll input stock prices starting from a value much below the lower strike price, that is much below 70, and I'll extend it beyond the higher strike price, that is 80, right? So this will ensure that we capture all the potential scenarios where the strategy might generate profits or losses. So what we can do is we can just start with a value like say 30, and we can give increments of $5 every time. Okay, so it's equal to 30 plus $5. Okay, and we can extend it up to a value say over here, say up till 110 it is extended, which is comfortably beyond the highest strike price. Okay, now let's start with the payoff and profit calculation. So we can start with the long call payoff first. So what is the formula for long call payoff? It is max of S minus K2 in this case, because that is the long call strike price, K2, comma 0. So it will be is equal to max of stock price S minus K2, and as I mentioned earlier, we'll use F4 to fix this strike price K2, okay, comma 0. So this is your long call payoff, right? Now profit, I have told this always in the class that when you are starting to understand the payoff and profits in the first place, initially always try and calculate the payoff first, and then you can calculate the profit for the long position by subtracting the premium from the payoff. This is how you should intuitively understand it in the beginning. Of course, gradually as you proceed, you will be able to directly calculate the profits, but it is a very healthy habit to start by segregating payoff and profit and calculating payoff first and then subtracting the premium from the long call payoff to get the long call profit. Okay, so my long call profit will be equal to the long call payoff, okay, minus the premium which has been paid, which is $5. Again, I have to fix this premium paid by pressing F4. So this is my long call profit, -5. Now for the short position, of course, it will be the opposite of the other side. If the long chooses to exercise the option, it will completely depend upon that. So the payoff will be negative of the payoff of the corresponding long position. Okay, so is equal to max negative of max of. So for short call, you have the strike price as K1, which is 70, right? So it will be 30 minus 70. Again, we'll have to fix this 70 using F4, comma 0. This is my short call payoff, again 0. And to calculate the short call profit, remember that short position has received the premium. So the profit will be payoff plus the premium received, which is 13 in this case, right? And we'll just fix the premium received again by pressing F4. So it is going to be $13 now. Now, since I have already calculated the long call profit and the short call profit, to find out the strategy net profit, I can simply add up the long call profit and the short call profit. This is my strategy net profit. Now what I'll do is I'll select all these entries and simply drag so that I can get the entire structure for the profits for different stock prices at expiration. So you can see very clearly that initially, I mean, as long as the stock price at expiration is less than or equal to 70, the strategy net profit is 8. It starts to fall below that, okay, and then the max loss is capped at $2. Very clearly you can see after 80 it is capped at $2. We can just draw the payoff diagram also once. So I just select this row, okay, and I'll select this row. I'll just click on this insert tab and I'll use a simple line chart. Okay, so I'll just use this simple line chart over here and I'll just drag it on the right hand side so that it does not interfere with the table. Okay, just resize it a little, and of course what we can do is we can just change the maximum and minimum bounds of the x-axis, because we started with 30, right? From 30 up to say only 110, right? So from 30 up to 110, let's just change the color also and make it a little bold. Okay, so let's change it to say red. We can just make it a little bold. We'll just increase the weight up to 3 points. That is okay. Now let's label the axis also. So I'll just add, click on the plus button, and I'll add the axis titles also. Okay, so axis titles I've added. I'll remove the strategy net profit over here. Okay, so this axis title is strategy net profit. Okay, and make it more clear. Let me increase the size. So this is strategy net profit, and this is this x-axis is the stock price, right? So this is equal to the stock price at expiration. Again, we can increase the size a little to make it more clear. So this is your graph. This is your graph. Okay, you can clearly see that maximum profit is occurring when the stock price is below this 70. Then the trader is receiving the net premium. Basically, the trader is retaining the net premium on the left hand side of 70. The break even is actually over here at 78. This is actually K1 plus the net premium received. So 70 plus 8, basically it is 78. Then the losses are capped beyond K2 or beyond 80. The losses are capped at 2, right? Now that we have analyzed the payoff diagram, we can just plug in these values over here. So the difference between K2 and K1, we'll just calculate simply 80 minus 70, C6 minus C5. Sorry, these are, we'll just write these down once again. They were wrong entries, I guess. So break even is, as I mentioned, it is nothing but the price, the strike price K1, okay, plus the net premium received, which is 8. Okay, so break even is actually 78. Max profit, how did we calculate max profit? Max profit was nothing but the net premium received. Okay, so this is 8. And the max loss, if you remember, we had given an intuitive understanding also of the max loss. So it is nothing but the spread, or this K2 minus K1, which we termed as the maximum exposure. Okay, this minus the net premium received. So what is your net premium received? Net premium received is 8. So this is your max loss. Fine. So these metrics summarize the overall behavior of this entire bear call spread strategy. Fine. So this Excel file also, this calculates and visualizes the bear call strategy step by step. So by first understanding the payoff and profit loss behavior, we can easily internalize the key metrics like break even, maximum profit, as well as maximum loss. So I hope this video was helpful to you. Thank you so much. We'll definitely try to bring more such videos for you guys. Thank you. Bye. All the best.